While many investors focus their attention and capital on traditional equities, commercial real estate, and even the timeless appeal of gold, one of the biggest and most explosive opportunities in today's global market may literally be hiding in plain sight. That asset is silver. Welcome to our comprehensive, deep dive into the complex and rapidly evolving silver market in the year 2026. For decades, silver has been misunderstood, often dismissed as simply the poor man's gold or a volatile industrial input. However, the reality of the 2026 macroeconomic landscape paints a vastly different and far more urgent picture. We are currently facing the sixth consecutive year of a severe global supply deficit. Recent estimates published by the Silver Institute point to a staggering shortfall of 46.3 million ounces this year alone. To put that into perspective, the global economy is consuming silver at a rate that the global mining industry simply cannot match. As industrial and technological demand surges from the massive rollout of advanced solar panels, the rapid proliferation of electric vehicles, the unprecedented build-out of artificial intelligence infrastructure, and the continuous evolution of advanced electronics, silver is transitioning from a basic commodity into a critical, irreplaceable strategic asset. We will explore exactly why global silver demand has remained stubbornly near absolute record highs despite global economic headwinds. We will also dissect why global mine production has completely struggled to keep pace, remaining virtually flat while demand skyrockets. This dangerous dynamic has silently wiped out over 762 million ounces of above-ground stock since the year 2021. Think about that for a moment. Over 750 million ounces of physical silver, the vital lifeblood of modern technology, has been drained from global vaults and reserves in just half a decade. Every single year, the deficit removes net metal from the pool of available silver, and a narrower deficit does not put metal back. It merely slows the drain. Whether you are a beginner investor looking to protect your purchasing power, or a highly experienced market follower searching for structural imbalances, understanding silver's dual role in the modern, electrified economy could help you spot massive wealth-building trends long before they become entirely mainstream. To truly understand the massive opportunity unfolding in the silver market, we must first look at the industrial demand boom. Silver plays a unique and highly critical dual role as both a monetary metal and an industrial powerhouse. But today, its industrial consumption is the primary, uncontrollable engine driving the market forward. Industrial applications now account for roughly 60% of total global silver demand, and this is not cyclical demand. This is structural mandated demand driven by global energy transitions and technological revolutions. Let us first examine the solar energy sector. As countries worldwide commit hundreds of billions to renewable energy transitions, solar photovoltaic technology has become one of the fastest growing applications for silver. By the year 2024, solar demand skyrocketed to 29% of the industrial total. Manufacturing advances have not reduced the draw on global silver supplies. They have actually increased it. Next, we must factor in the electric vehicle revolution. EVs are fundamentally altering automotive supply chains. An electric vehicle requires significantly more silver than a traditional car, used in battery systems and power electronics. A modern battery electric vehicle consumes approximately 25 to 50 grams of silver per car. But perhaps the most explosive driver of silver demand is the unstoppable rise of artificial intelligence. AI servers and data centers demand absolute perfection in power distribution and superior heat dissipation. Because silver has the highest conductivity of any element, it is entirely irreplaceable in advanced applications. Global IT power capacity has increased by 53 times since 2000, creating an enormous demand for physical silver. Technology giants will not halt billion-dollar projects because silver prices doubled. The demand is locked in. Over half of all silver mined each year is immediately swallowed up by industry, removed from the supply chain forever. With demand surging to such historic and unprecedented levels, a logical question naturally arises. Why cannot the global mining industry simply dig more holes? Why can't they ramp up operations and produce enough silver to meet this surging demand? The answer lies in the unique structural inelasticity of silver mining. Unlike copper, iron ore, or even gold, the vast majority of silver is not mined on its own. In fact, approximately 70% or more of all silver produced globally comes merely as a byproduct of base metal mining operations. When massive mining conglomerates dig for copper, lead, and zinc, they occasionally find silver mixed into the ore. Consequently, the global supply of silver does not react swiftly or efficiently to silver price signals. If the price of silver suddenly doubles, a copper mine is not going to spend billions of dollars to expand its entire operation. They prioritize the economic viability of their primary metal. Because of this extreme inelasticity, global mine production has remained largely flat for years, yielding roughly 846 million ounces annually despite skyrocketing demand. Developing a brand new silver mine takes 10 to 15 years. you have to navigate complex environmental regulations, secure massive capital investments, and overcome immense geopolitical hurdles. This is especially true in regions where legacy ore bodies are maturing and ore grades are steadily declining. When you combine this rigid supply chain with aggressively surging industrial demand, you get a massive structural deficit. For the fifth consecutive year in 2025, the world used significantly more silver than it produced, suffering a shortfall of over 40 million ounces. The World Silver Survey for 2026 expects this dangerous streak to extend, forecasting a wider gap of 46.3 million ounces. Set against 1.1 billion ounces of yearly demand, a 46 million ounce deficit might read like a rounding error to the untrained eye. But the real danger lies in the accumulation of these deficits. Every single deficit removes net metal from the fragile pool of available silver. The cumulative drawdown is over 762 million ounces since 2021. We are rapidly draining the world's bank account of physical silver. Furthermore, the pressure shows up heavily in how much remaining inventory is free to trade. A growing share of metal sits locked inside exchange-traded products or deep inside exchange vaults, unavailable for industrial buyers. This proves that the physical market is already buckling under the pressure of these continuous deficits. While the industrial story of silver is undeniably compelling, we cannot ignore its rich history and ongoing role as a profound monetary asset. Historically, silver has acted as both an industrial workhorse and a trusted monetary safe haven, heavily influenced by its complex relationship with gold. When we compare silver to gold as an investment vehicle, the single most critical metric to understand is the gold to silver ratio. This ratio tells us exactly how many ounces of silver it takes to purchase 1 single ounce of gold. It is a phenomenal tool for determining when silver is drastically undervalued relative to its yellow cousin. Throughout monetary history, this ratio is often fixed by governments at roughly 15 to 1. However, in the modern era of floating fiat currencies, it fluctuates wildly. In the post-2000 era, the ratio has averaged around 60 to 1. But during times of extreme economic stress or explosive precious metal bull markets, silver historically outperforms gold, causing that ratio to compress violently. We witnessed a perfect example of this mechanism in January of the year 2026. In a stunning market move, the ratio compressed dramatically down to 46 to 1 when the price of silver briefly spiked past $100. This movement was fueled by inventory panics and industrial hoarding. What makes silver so uniquely powerful right now is how it behaves during periods of macroeconomic stagflation. Stagflation is an environment characterized by persistently high inflation, slowing economic growth, and stagnant wages. Most traditional assets have a simple, predictable relationship with stagflation. Government bonds lose their purchasing power as inflation eats away at their fixed yields. Equities struggle massively with the slowing growth side of the economic equation. Cash erodes by its very definition. Gold naturally wins in this environment because real yields are suppressed and central banks are trapped. Silver, however, is far more fascinating because it answers to two entirely separate demand pools: industrial consumption and monetary investment. In most normal macroeconomic environments, these two forces pull against each other. If the economy is booming, industrial demand rises, but monetary safe haven demand falls. If the economy crashes, monetary demand spikes, but industrial factories shut down. Stagflation is the incredibly rare, perfect storm where both engines fire at the exact same time. Industrial demand from solar panels, electric vehicles, and AI data centers is driven by long-term structural government mandates. They will continue buying silver regardless of a recession. Meanwhile, inflation drives investors into physical silver to protect their wealth. When both engines pull in the same direction simultaneously, the resulting price action can be absolutely explosive. However, any thorough financial analysis requires a balanced perspective. Potential risks and rewards are something every single prudent investor must deeply understand. Before deploying capital, one must realize no investment thesis is entirely without headwinds, and silver is certainly no exception. As silver prices rise aggressively, profit margins for massive technology and solar manufacturers are severely squeezed. To protect their bottom lines, these manufacturers actively seek to thrift, which means using less metal per unit. Or they may completely substitute silver with cheaper alternatives. While silver remains the undisputed gold standard for electrical conductivity, high prices force the solar, photovoltaic, and advanced electronics industries to heavily experiment with copper or alternative base metal alloys. If a technological breakthrough allows manufacturers to eliminate silver without sacrificing efficiency, industrial demand could theoretically take a significant hit. Additionally, we must monitor the secondary supply from recycling. Extreme price spikes make the labor-intensive recycling of electronics and silverware viable. In the first quarter of 2026, secondary recycled supply hit multi-year highs of roughly 197.6 million ounces. Higher prices successfully coaxed scrap metal out of hiding to attempt to bridge the massive global supply gap. Furthermore, the silver market is notoriously small and volatile compared to gold or equities. This means prices can suffer brutal short-term corrections even during a long-term bull market. So, why are so many mainstream market participants, hedge funds, and retail investors still completely overlooking this glaring opportunity? Simply put, the complex, dual nature of silver makes it incredibly difficult for traditional Wall Street analysts to model and understand. It does not fit neatly into a standard technology portfolio, nor does it act perfectly like a traditional currency. Yet, the underlying physical fundamentals remain stark, undeniable, and deeply concerning for the global supply chain. With over 762 million ounces completely erased from global inventories in just the past half-decade, an unstoppable industrial demand driven by world-changing megatrends like artificial intelligence, electric vehicles, and the massive global energy transition, the structural floor for physical silver has rarely, if ever, been stronger in human history. We are watching a slow-motion supply shock collide head-on with an industrial renaissance. Whether you are a beginner investor just starting to build a resilient portfolio, or an experienced market follower looking for the next major asymmetric trade, understanding silver's critical role in the electrified economy could help you spot wealth-building trends before they become headline news. The era of cheap, abundant silver may be coming to a rapid and permanent close. Do your own research, understand the immense physical constraints of this incredible metal, and consider how a structural deficit might impact your financial future. Thank you for watching.